China's high-tech manufacturing loans raise fears of wave of cheap exports. China's leaders, determined to upgrade manufacturing, are steering money toward makers of high-tech products, from semiconductors to EVs, raising fears that overcapacity will fuel a new wave of cheap exports. Lending data from China's central bank offers a glimpse of government priorities. As of the end of September, outstanding loans to the troubled property sector fell 0.2% year-on-year, but lending to the manufacturing sector jumped 38.2%. Economists caution that this wave of investment differs in key respects from an earlier capital investment surge that, among other effects, inflated China's solar panel industry, triggered a trade fight and put scores of companies out of business. But the trend has alarmed some key trading partners, particularly in Europe, where an investigation into Chinese EV subsidies is underway. There is lower consumption in China right now, but you have massive overcapacity that is being pushed out to the world, including in batteries, solar and chemicals, said Jens Eskelund, president of the European Chamber of Commerce in Beijing. Europe and China are like two trains that are going to collide, Eskelund said, referring to trade. China's industrial policy will be on the agenda at this week's meeting of the Asia-Pacific Economic Cooperation (APEC) Forum in San Francisco, where Chinese President Xi Jinping is expected to meet U.S. President Joe Biden. Under Xi, China has sought to make itself an advanced manufacturing powerhouse for high-end goods for the world, including EVs, wind turbines, aerospace components and advanced semiconductors. Critics say the push has come at the expense of another need to get China to consume more and export less, a structural shift many economists see as key to preserving high levels of growth. Advanced sectors. Policymakers have struggled with overcapacity before. Stimulus following the 2007-2008 global financial crisis triggered a boom in steel, solar and other areas, but also generated growth that ultimately helped absorb much of that new production, said Frederick Newman, chief Asia economist at HSBC. This time, the government's focus is narrower, targeting high-tech and advanced manufacturing, a goal laid out in 2021 in the 14th Five-Year Plan. China has adopted a strategy to shift investment spending from the real estate sector into manufacturing, which will drive up capacity further. Rather than boosting goods absorption via surging construction, China is opting to drive up the capacity of goods-producing industries, said Newman. Global markets, unfortunately, are not in a position to absorb the additional capacity. Another difference from previous episodes of overcapacity: the sums are smaller. The headline growth rate for financing into manufacturing is likely close to 18%, said Dao Wang, chief China economist at UBS, because the other major source of financing for companies' bonds is down sharply, meaning a more modest combined increase. And overall investment growth in Chinese manufacturing has been slowing as producers respond to a weak market. Orders and profits are down and they tend to react to that, said Wang. Still, investment in high-tech manufacturing outpaces the rest of the sector. It grew 11.3% in the first 9 months of 2023 year-on-year, compared with 6.3% for overall manufacturing investment, according to data from China's National Bureau of Statistics.